So welcome to everybody. I'm very happy having today Nicolas, Véron, and Tobias Tröger talking about capital market union. That is a topic that I'm sure is of interest to all of us. And so we are planning to have a chat about two very nice pieces produced by Nicolas on one side as a response to the eGov request to let's say, where do we stand about the capital market union and why we are not able or we will be able to make some progress. And then a very nice, another white paper produced by Tobias Tröger and co-author at SAFE, Florian Haider, Jonas, and so on what are the main, let's say, obstacle of implementing capital market union. So the way in which we are going to organize this webinar, I'm giving the floor first to Nicolas for 10-15 minutes, and he's going to present to us very quickly the key, let's say, aspect of his document. And then I will give the floor to Tobias, and he will also provide a summary of the SAFE white paper. And in the meanwhile, I will ask all of you to contribute to, with questions at the Q&A, that then we will have, more than 30 minutes to discuss on what are the limits and what we should do about, this important topic that clearly it will become even further relevant after the election, the European election in June. So I'm giving the floor first to Nicolas Véron, that I know that all of you know, but Nicolas is Senior Fellow at Bruegel and Peterson Institute for International Economics. So Nicolas, thank you very much, and the floor is yours.
Thank you so much, Loriana. Thanks to the whole SAFE team and Florian and everybody. I mean, I've been always an admirer of what you have built in Frankfurt, not only metaphorically, but also your House of Finance in your background, Loriana. And have been almost present at the creation. I remember conversations with Jan Khan, and to me, it's extremely rewarding to be now part of your program in this seminar. So thank you for that. As you said, the paper I will present was prepared for the eGov, so the Econ Committee of the European Parliament and the services of the European Parliament, as they often do, and in this case, in the context of the preparation of the new legislative cycle. So it's a forward-looking paper, but it also looks backward at the history. And I also want to say up front that I think the white papers that you guys published last month is a great contribution to the debate, and I very much look forward to the discussion. Okay, so let me say what is in the paper, which is available on the website of the European Parliament, and I will try to summarize it extremely quickly. There's the first part, which is about the history, and the history of the Capital Markets Union. We know when it starts, because the expression Capital Markets Union was coined by Jean-Claude Juncker in his program speech, his Maidan policy speech, as president-elect of the European Commission in front of the European Parliament in mid-July of 2014. So that's when the expression Capital Markets Union was first used, and we will celebrate or deplore the 10-year anniversary in about 2 months. The expression was coined in a very particular political context. The banking union had started also on a specific date, which was almost exactly 2 years before. People started to use the expression banking union in the spring of 2012, and it became an actual policy proposition with the famous meeting of the Euro area heads of state and government in the early hours of June 29, when they said, we affirm that it is imperative to break the vicious circle between banks and sovereigns. And essentially, they decided, long story short, to endow the ECB with banking supervision. Of course, that was implemented subsequently, and actually when Juncker coined Capital Markets Union, what we now call European Banking Supervision, or the Single Supervisory Mechanism, the SSM, was not yet in place, but it was approaching the final stages of, for those who remember, the comprehensive assessment, which would lead to the transition of authority from the national to the Eurozone level for banking supervision, which happened on November 4 of that same year, 2014. So banking union was on track at that time. It was considered a great policy success of the EU, and therefore coining capital markets union was a way to bask in the reflected light of that success and to say, okay, we started to work with banking union, we're continuing with capital markets union. But that's not the full story, because there was another very important parameter, which was the situation in the UK. And here it is pretty clear, even so I don't think it has been established as a fact, that Juncker really wanted to have a positive sounding project for the UK that would reassure the British public that they were not being sidelined by the greater integration into the Eurozone. You remember the famous expression by George Osborne saying there's a remorseless logic to supervisory, but also policy and ultimately political integration into a Eurozone. That was a very stark statement. That was the time when Cameron had said he would probably consider a referendum on exiting the European Union or not. And essentially, capital markets union was a way to say, no, the Eurozone is not the center of the action. Actually, London and the UK, as the center of European capital markets, is the center of the action, is the center of my policy, because clearly, if you do a capital markets union, it has to be in an EU 28 at the time, London-centric, essentially, and UK-centric. So I think this political context matters a lot because it led the Juncker Commission to define capital markets union in a very consensual way. Basically, they didn't want to make harsh choices that could make the project controversial in the UK and undermine the chances of the referendum. But on the opposite, it was the contrary. It had to be a kind of, what in the US they refer to as motherhood and apple pie, things that you couldn't really be against. And I think that led to the original kind of fuzziness and lack of clear definition of the capital markets union. Of course, the political intent failed because the referendum ended up with Brexit, but I don't think you can blame either Juncker or the capital markets union project for that. I think it was a valuable attempt to create a positive narrative in the UK, and the fact that it failed is just, the way it happened. But I think largely because of this lack of clear policy definition, the capital markets union has been very unsuccessful as a policy project in the ensuing decade. And I think now, I won't elaborate on this, but there is a very broadly shared view that it hasn't delivered. Now, let me expand a bit on those lessons learned. I like to think of capital markets union as, you remember that Jonathan, sorry, help me. What was the name of the commissioner? Jonathan Hill. Sorry, my memory is fading. If Jonathan Hill is watching us, I should say it's really not personal. It happens to me with all kinds of names these days. So Jonathan Hill, Commissioner Hill, like to refer to low-hanging fruits, and that the capital markets union, very much in line with what I said about Brexit, and by the way, appointing a British commissioner in charge of the project with the title of Commissioner for Capital Markets Union, Financial Stability and Financial Services, or in a different order, was also part of this kind of UK-centric vision. Commissioner Hill said, we want to focus on the low-hanging fruits, which was a way of saying we don't want to touch the controversial topics. So I like this metaphor, and I will talk of capital markets union as having three categories of fruits. There's the low-hanging fruits, which are basically continuing what the European Commission has always done, capital markets integration legislation, at least since the Financial Services Action Plan of 1999. This has been the bread and butter of what was in the past DG Markt and is now DG FESMA. Then there are high-hanging fruits, and I think the main lesson of the past 10 years is how high-hanging they are. And this is taxation, particularly investment taxation, insolvency law, pension finance, and I would add to this housing finance, which, by the way, is prominent in the recent Noyer report on a French vision for capital markets union, which is going to be discussed at the Eurogroup, I think, very shortly. So these areas, unlike financial regulation, are actually not areas where the European Union has a political mandate to drive policy. And we can discuss the legal and political aspects of it. But I think, for lack of time, I will just say those areas, taxation, insolvency law, housing finance, pension finance, they're a matter for the member states. And so the EU cannot be nearly as ambitious in those areas as it can be in financial services regulation, because in financial services regulation, conversely, there has been a kind of secular shift, which I think was initiated really by the creation of the euro, because finance participates in the currency. I mean, the financial system is the way monetary policy is transmitted to the economy, and I think that has separated the financial sector and its regulatory policy from other tricky areas and really forced a consensus, which of course was crystallized by the inception of banking union, that this is really a matter for EU policy and not just national. So I think that defines what I would call the medium-hanging or the mid-hanging fruit. And I think the mid-hanging fruit, of course, is supervisory integration in capital markets, which is the exact equivalent of what was achieved in banking, which, by the way, was considered impossible before the Eurozone crisis, which is essentially to have a central, empowered, credible, effective supervisor. I'll come to what that could be, which then works, of course, with national authorities in some form of way to ensure the right compliance with subsidiarity. And I think people sometimes say, who cares about supervisory architecture? These are the bureaucrats, etc. But practitioners know how inaccurate that narrative is, because the supervisors really shape the markets. They have a lot of power over the financial sector. In the case of banking, the banking license. In the case of capital markets, it's a much more complicated array of dozens of different mandates, which makes the discussion in a way much more amorphous and complex. But essentially, if you have national supervisors who think in terms of, sorry for my language, pardon my French, economic nationalism or financial nationalism, they want to promote the local actors, they want to defend them against the foreign competitors, by which I mean other EU member states, that creates a completely different set of incentives from when you have an integrated supervisory framework where ultimately the decisions are made at the European level and with incentives to favor, not disfavor, cross-border integration. So I think that's hugely important. Now, let me finish by briefly concluding on the prospects. So what to do when I say supervisory integration? In practice, I mean ESMA reform and empowerment. I think we're not starting from nothing. ESMA exists for better or worse. It is an authority, and I should, by the way, disclose that I'm a long-standing non-executive independent director of an entity which is supervised by ESMA, the trade repository operated by DTCC. I don't think it puts me in a position of conflict, but I think it's a due disclosure. Having said that, ESMA has, very great leadership and stuff, but I think when you look at their legislation, the legislation that establishes their authority, they really don't have the governance and funding framework that corresponds to enabling an effective supervisor. And therefore, the reform of ESMA has to come first, a kind of ESMA 2.0, with reform, governance, funding, but also something that is not sufficiently addressed in the paper and that we may discuss later on today, which is the supervisory model. Should it be like, joint supervisory teams, like with the ECB banking supervision or something different? And then, if it becomes an effective supervisor, you can expand its scope of authority, and including, of course, things like critical market infrastructure, audit networks, and other entities. So let me stop here with just a word about the prospects. Since the paper was published, I think, in February or March. Since that was published, I think there has been a lot of momentum in the policy community, and I don't know exactly why, but maybe Tobias will explain, because I think a lot of that has come from Germany and actually from the top. So Chancellor Olaf Scholz seems to have come to the conclusion that capital markets union was important, and I think maybe as a consequence, French President Macron has come to the same conclusion. So now it has been elevated to the leaders level. It has become Chefsache. And those of us who remember the inception of banking union know how important that is. So basically a problem that could not be solved at the level of finance ministers may be addressed more effectively at the level of heads of state. And I think from that perspective, last month's European Council was inconclusive but important, and I'm very curious to see what will happen on the next one in June. Let me stop here. Thank you very much.
Nicolas, thank you very much. I remind to the audience that there will be a Q&A section. So if you have already question on what Nicolas has introduced, please start to write. I'm moving now to Tobias Tröger, that is one of my colleagues at SAFE. He is the head of the Law and Finance cluster at SAFE, and he's also professor of private law, commercial and business law at Goethe University, on top of being a CEPR research fellow. And he is one of the co-author of this SAFE white paper, together with Florian Heider, that is also connected here, Jan-Peter Kranen, Katja Laudenbuchen, Vincent Lindner, Jonas Schleiger, and clearly Tobias is one of the co-authors. So Tobias, the floor is yours, and we are very curious to know what you have to tell us.
Thank you so much, Loriana. So I kind of really thank the organizers for putting me on this program, as I'm part of this institution. And above all, I kind of even claim that we had a mandate to write that paper like Nicolas had. So we just babble around because we think we have something to say. And what is it that we have to say? Because we don't have a mandate, but I have slides. What we do is essentially we present our vision because we think there is a problem with the Capital Markets Union project at TAN, which also has been nicely put by our speaker, Nicolas, who said the Capital Markets Union from its initiation has been big on rhetoric, but weak and small on policy. And what we see now coming out of the Brussels institutions are all these reports. There's the Noyer report, which Nicolas mentioned. There's also the Letta report, which has a big section on the Capital Markets Union. There's a Eurogroup statement. And they're all very, very laudable, and they put a lot of interesting food for thought in front of us, but they're very piecemeal. And what we think our contribution could be is to just name one of the reasons why we think the Capital Markets Union project is truly important these days, and also point to the big picture avenues which are out there in order to achieve the objectives of the Capital Market Union, but also make clear that there are common challenges. No matter which policy route you choose, the main policy obstacle clearly is that there is an imminent need to relinquish sovereign power by member states. And let me just start off by showing you why we think there is a window of opportunity that Nicolas hinted at it. Maybe Olaf Scholz has realized, and Emmanuel Macron certainly has realized, that, of course, the objective is to create a well-developed, liquid and deep capital market that is eventually rivaling global financial centers. People tend to say Wall Street, but if you walk down Wall Street, there's not much going on there. But what they mean, of course, is the global financial centers. And then there comes all this romantic rhetoric. We want to empower the green transition. We want to enable the blossom of innovative startups and the rapid growth of these startups into global champions, and have savers share in welfare gains. And we also like world peace. So it's like, that's just too good to be true. But why is the Capital Markets Union project so important these days? Because we think the world has changed dramatically, and we encounter an age of rising geopolitical frictions. And this is important because if you want to pursue your strategic goals in a world that is characterized by power dynamics, then of course you have to have a capital market which makes you economically sovereign. It has to work in order to finance your economy. It has to reduce your dependence on external funds, and therefore you can push a little bit stronger on your other policy goals, because other power players cannot threaten that they will withdraw essentially the money that you need in order to finance your economy. And therefore, it is important to have an optimally functioning capital market, particularly in a world with geopolitical frictions. And of course, more nitty-gritty, it also gives you more power in the international negotiations about the shape of financial regulation, because you have one point to turn to, one voice to speak with, and that, of course, is an important aspect here. Now, what we sketch in the paper as well is two avenues for achieving this goal, which pitch a little bit institution building very much along the lines that Nicolas just sketched, versus a regulatory competition vision that is more in line with a market-based approach, and therefore mirrors a little bit the Austrian school's distinction between planned and spontaneous order. But it is quite important to understand that the spontaneous order does not come about so spontaneously, because it requires a momentous political or legislative intervention in the form of mandatory mutual recognition of financial regulation and supervision in the EU. I will come to that in a second. Now, market integration through institution building. Nicolas has already hinted at this. I just want to add a little bit to this, because there's a historical example, in a sense, a case study, which is the United States Capital Markets Union, if you want to call it like this, which was, at least in important respect, also shaped by the New Deal legislation, the Securities Act and the Securities Exchange Act, the 33 and 34 Acts, and in particularly the installation of the central supervisor, the Securities and Exchange Commission. And there is literature out there which shows that, of course, all of this is insufficient in itself, but if it comes on top of certain pre-existing market integration, then it can really make a difference. And that's exactly the situation that we face in Europe. And therefore, looking at this example might be helpful. Nicolas has already sketched that this could come in the form of empowering ESMA. You could also establish a new authority, all of this to be discussed in detail. And the alternative model that we also sketch is that of mutual recognition and regulatory competition. So you do not establish a centralized regime, but it comes about by choice of market participants. So market participants choose the regulatory regime for the transaction that they think is the most favorable, and over time, this will establish also a uniform regime, both in regulation and supervision, because more and more everything will migrate to one jurisdiction. And this doesn't necessarily have to be one jurisdiction for all kinds of financial market transactions. There might be equilibria which simply show that for this kind of transaction, this jurisdiction dominates, for others, it's others. There's also a historical case study, which is the corporate law harmonization, quote unquote, in the United States, Delaware as the competing and winning chartermongering jurisdiction. And this is something that is very much in line with the idea that we have, and we've written extensively even before anybody coined the term capital markets union on this, and why this is transferable. Because one of the key objectives that I just want to hint at here is, would not a regulatory competition lead to a race to the bottom? And it's clear that in capital markets transactions, this is a very implausible outcome, because there's market discipline, because in every transaction, there are two sides. So every seller needs a buyer. And if you're engaging and providing just a product that is inferior, it will not necessarily lead to a stable outcome, and people will not accept that. And therefore, we don't think that this necessarily goes into the direction of a race to the bottom. And more important for us is not so much which avenue you embark, but more that you're aware what is the common challenge. Because either in institution building or in a regulatory competition, sovereigns need to relinquish power. So either to the supranational institutions or to markets and ultimately other member states. I already hinted that mutual recognition does not come automatically. It requires a consensus among the member states that they accept the outcomes of foreign regulatory environments and supervisory practices. And that's exactly the kind of seizure of sovereign powers that is needed. And therefore, both models essentially face the same political opposition because the private and public sector incumbents, so crowd supervisory agencies, marketplaces, etc., would lose power, and they are potentially losers in this game, and therefore they will, of course, mount opposition. But it is important to understand that this will always be the case. There is no way around it. The only alternative is just muddling through with piecemeal attempts to integrate the low-hanging fruit that Nicolas has mentioned, but they will not necessarily lead to success. And therefore, it's just better to tackle the challenges that we will face heads-on, because clearly the Capital Markets Union project so far has mainly failed because member states either wanted to retain sovereignty and protect national interest groups with lobbying power, or these interest groups were just from the get-go not really targeted. So it was something that did not really rub them the wrong way, that was attempted and therefore didn't go anywhere. Let me just stop here because I'm very much looking forward to the debate. Thanks for your attention.
So very good. Thank you very much, Tobias. I think that you point to several aspects that are extremely interesting. So I'm, opening up to the floor, but I think that the first, aspect that I want to address is that, Tobias has already, in some sense, provide some indirect comments to the eGov document and the proposal that Nicolas provides. I will be happy if Nicolas, for example, comment on what Tobias just presented. And mostly what I want to know is his view about the sovereign power and these geopolitical frictions that pretty much prevented so far the implementation of a proper capital market union.
Thank you so much. So I think there are two questions in your question. Obviously, there's a lot of overlap between our respective analysis. So we're saying largely the same things. I think one point of difference is that the SAFE white paper suggests two options, a centralized and a decentralized option, whereas I recommend the centralized option, essentially. And I didn't, in my paper, specifically discuss the decentralized option or the mutual recognition model because the white paper had not been published yet. So I was unlucky to go first. And your second question is essentially, can it happen, right? I mean, given the sovereignty baggage, is that even possible that the member states would agree to share sovereignty? And as Tobias rightly reminded us, for the mutual recognition model to work, you need that explicit willingness to share sovereignty, because otherwise you basically have the current system. I mean, you could depict this current system as regulatory competition. You have national authorities, you have largely harmonized legislation and regulation. The difference with the models that is suggested in the paper is precisely that the national authorities have powers and incentives to erect barriers. So you would have to find a way, I'm curious to know what kind of way could be found, to basically disarm the tempter and make sure that the national authorities can no longer listen to their incentives and erect barriers. So that's a question to Tobias, and in a way that my reaction on one of the two questions, which is why not advocate the decentralized regulatory competition model? My short answer is because the national authorities would still have incentives and possibility to erect barriers, but I want to know why I'm wrong. And by the way, just to complement my point, when you look at the banking union has integrated supervision, but as you know, as we all know, it doesn't have integrated crisis resolution and crisis management, including but not limited to deposit insurance. And that's exactly why the national authorities still are able to ring fence and force the ECB to keep the ring fencing, because they have authority not as banking prudential supervisors, but as resolution authorities and deposit insurers, which allows them to create a ring fencing mandate. And I think as long as you still have this kind of national authorities, they will create barriers. Okay, so why do I think something may happen in terms of pooling sovereignty? First, I think if you compare with banking union and what I just said about crisis management and deposit insurance, in a way, the immediate fiscal undertones of the capital markets union discussion are less strong. So we know that in banking crisis, if only through deposit insurance and possibly through a bit more, fiscal authorities may be on the hook. And that is one of the key reasons why finishing the work of banking union is so difficult, even so the supervisory piece now, in my judgment, is basically complete. But you don't really have that on capital markets, with a possible exception of critical financial infrastructure. But for a lot of the things we're discussing, and even that I see your body language, Loriana, is debatable. But for a lot of the things we're discussing, like financial transparency, auditing, accounting, trade reporting, asset management, you basically don't have any discussion of a fiscal backstop. So the sovereignty that we're talking about is not fiscal sovereignty per se. It's more kind of, sovereignty to keep organizing their own national markets. And I think at the end of the day, it's a lower barrier. So I think in a way, it's probably more easy politically to achieve supervisory integration, which I know is not the full capital markets agenda, but it's basically what both our papers are focused on, than to complete the banking union. And I think that's exactly what we're seeing now, as Tobias rightly said, because of the geopolitical context and so on and so forth. Scholz and Macron want to achieve something, and I think they identify correctly supervisory integration as the one thing they could do at the least political cause that would still make a difference. I insisted on the difference between finance ministers and political leaders, and I think that's exactly what's at stake here. The obstacles to supervisory integration into capital markets union are largely inertial. There are special interests, there are special interest of supervised firms, and they can be very powerful. There are special interest of the existing agencies that can create a lot of inertia because they defend their turf. I'm talking, of course, of the national regulators as they exist. I don't blame them. I would do the same if I were them. And in that, you have an ESMA which is governed basically by the national supervisors, which have all the votes but one in the board of supervisors of ESMA, and that basically cannot act as an autonomous actor in that debate, given its governance. And I think all these interests can be superseded when you're at the level of head of state and government, because precisely of the geopolitical context and other factors which create a sense of urgency. Why don't I stop here, Sarah?
Okay, so Tobias, do you want us to react? And then I give the floor to some questions.
So as Nicolas was ending on essentially a consensus note, I just want to put one thing in perspective. I think that what you said about the possibility of national supervisors to essentially still protect national interests and groups with lobbying power, I think that's sort of owed to the fact that you're not accepting that we really push for the full solution, which is that exactly that is not possible, because then the competition, if you're favoring national champions, would put you at a disfavor, essentially leading to probably transactions not coming at your jurisdiction, and therefore you would be at a loss. And of course, I think the basic idea behind this mutual recognition model is really think it through. There's just no way of interfering with the choice of market participants. And you're always assuming there are. And I totally agree with you that, of course, the missing picture is that the only thing that matters for financial market regulation, financial market regulatory regimes is supervisory practice. Because what you write on the books in all these legislative texts doesn't matter if it is interpreted in a totally different way here and there. And therefore, I think the key message really is what we envision for our model to work is the full mutual recognition without any potential for ring fencing, et cetera. And this is why this is such a big sovereign loss. And on the other note, I think I fully share the view that heads of state, by definition, are more looking to the big picture. And all the arguments are there, the efficiency arguments, the geopolitical arguments, and they might actually tilt at some point the difference. I just want to hint at, we're facing a European election, which will certainly not lead to a European Parliament that is more pro-European, pro-integration, et cetera. So this is going to be a challenge. But on the other hand, it is the capital markets union, let's face it, is not a project that wins the hearts of voters or makes them more disgruntled. It probably makes them a little bit more disgruntled, but not that severely. It's not really something that populists these days target.
Some two more things because we're in this conversation. So I want to make two additional points. Essentially, what I'm saying on the two options is because the regulatory competition option actually requires, as Tobias rightly said, the same difficulty of sovereignty pooling as the centralized option. I think the centralized option is kind of a more sensible way to go because there are question marks about the regulatory harmonization's feasibility. And especially given that finance, at the end of the day, will remain a regulated sector where you can really prevent the national authorities, which will be the only regulators that exist, from doing their national thing. Whereas for the centralized model, or hub and spoke if you want to be diplomatic, we have proofs of concept. We have the European banking supervision, which works. We have now the same thing in anti-money laundering, which is not yet in place, but is legislated and will happen. And we also have, to a much more limited extent, which I wouldn't take necessarily as a role model, direct supervision by the European supervisory authorities. So essentially what I'm saying is you have two possible models. Let's accept that if you're willing to pool sovereignty, one of them is kind of tried and trusted. The other is more theoretical because, as Tobias said, you can say it works in corporate law in the US, but not in securities law. So in securities law, you would look more at something like Canada. And in Canada, where the provinces are sovereign on securities law, essentially, we know where it leads, which is one province taking basically all the business. And I think Tobias implied, and I agree, that this is not necessarily an acceptable outcome in the European context. But I actually am preempting him, so I would be interested in Tobias' views about Canada. Anyways, the second point I wanted to make more briefly is that the way I describe the incentives of the head of state and government is actually not for all countries, because there are countries that have made kind of a core interest of their economic model that they would create a comparative advantage in capital markets. And that, for the most part, is good. But to the extent that part of that comparative advantage is connected with a form of lax supervision, and I think there is some such extent, that makes them extremely opposed to supervisory integration. And that's basically what we observed in the previous phase of that debate, which for the nerds happened around 2017-2018, when the Commission presented a proposal which is called ESA's review, but which these issues were already debated. And as everybody knows, there were particularly two member states that were firmly opposed. They created a coalition, and we saw the same thing in last month's European Council, where a lot of the smaller member states, but were very opposed to the idea of supervisory integration, but with different degrees of intensity. So essentially, a replay of the 2017-2018 discussion. So then the question becomes, if it failed in 2018, why won't it fail this time? I think the answer is the geopolitical context, is the fact that you can have a critical mass of countries that actually would want it to happen. And remember, this is not unanimity, this is qualified majority under Article 114, so it's possible to have a decision without all the member states, especially the smaller ones, being on board. Of course, there will be a willingness to create consensus. Let me mention here what I think is an important twist to the ESMA empowerment story. Because when I say ESMA empowerment, and with my French accent, people rightly believe, okay, one other of those French people who want ESMA to be more powerful because ESMA is in Paris. Well, on this, I disagree with some of my fellow country persons, compatriots, because I think ESMA is in Paris. That probably cannot be changed, but you can imagine a model where actually this agency in the future operates not just out of Paris. And there is, to my knowledge, no legal obstacle until Article 114, even though there aren't real precedents, to creating an agency that maybe has a headquarters and, the meetings of the board in Paris, but has an actually distributed footprint of activity with maybe, let's dream a moment, let me say something completely nonsensical, audit supervision in Amsterdam, infrastructure supervision in Frankfurt, asset management supervision shared between Dublin and Luxembourg, what have you. So you could have, and something else in Madrid, Milan, Stockholm, what have you. Not only the Eurozone, by the way. It's sketchy. And I think more work needs to be put into it, and I'm working on that for a publication at Bruegel probably later this year. But I think it's possible to imagine a model where a stronger, more empowered ESMA would not just mean more stuff happening in France. Thank you.
So thank you very much, Nicolas. So let me move to the question. There are several questions on the Q&A, and I want to give a little bit of space there. So on one side, there is the first question that they want really to understand what is the role of taxation in insolvency and so on capital market union. Clearly you were mentioning this, but clearly the clear connection maybe is not so clear. So why we are not spending just few words about this? We can start with Nicolas and then Tobias, because it is both documents.
I've been speaking too much, so let Tobias go first.
Yes.
Well, but you brought it up and you just dump it on me. So okay. So let me talk a little bit about insolvency regime. So I think that it's not immediately intuitive, and also not immediately intuitive to me that this matters, but it does. The reason is, of course, at the time of investment and the choice of investment, of course, people don't think that much about what could go possibly wrong. But of course, at the end of the day, it matters. And if you look at a little bit about beyond the typical capital market bond or even equities, more forms of structured financing, and also more risky forms of financing like private equity, venture capital, then of course the downside of your investment matters a lot. And if you cannot really predict the downside of your investment, then it becomes really difficult. And why can't you predict it? Because of course the future is uncertain, but mainly because you don't really know which regime will govern the insolvency of a more complex transaction on capital market. And you cannot, and you don't want to engage with the sovereign regimes of 27 member states, where you could potentially end up with your insolvency proceedings. I mean, that's exaggerated, but at least if it's a cross-border investment, then of course it is unclear what really matters. And therefore, harmonizing insolvency law brings more certainty and therefore more predictability. And that is a determinant which at the margin can generate more investments. And, coming back to the example that I love so much, the United States, that has a federal bankruptcy code. And therefore, exactly this certainty and this predictability exists. And the same obviously is true with regard to taxation, because that affects obviously the upside of your investment. And if you're not 100% sure which tax regime will govern, then of course it is a matter of just rationality to put a discount on your investment, and therefore your willingness to invest in the first place is decreased at the margin, and therefore both regimes obviously matter. And you know, particularly for one of the objectives of the Capital Markets Union to make capital market financing more accessible for SMEs, there, of course, the possibility of insolvency, of bankruptcy is pretty is not so remote as with blue chip investments. And also, of course, the taxation of the capital gains that you can generate with your investment matters quite a bit. And therefore, I think with regard to Capital Markets Union project targeted at SMEs, both regimes matter quite a bit. But Nicolas can add.
I completely agree. I think the Capital Markets Union has always had this duality of being both a developmental project of capital markets development and an integrationist project of capital markets integration. And essentially, and I've evolved over the years on this, at this point, these structural policies like insolvency law, I view them more as development policies. Because I've kind of given up on the possibility of harmonization that would really create an integrated space for the stuff that Tobias talked about in terms of having the same outcomes in different member states. But I think you can reduce the uncertainty and also, frankly, reduce the quality of the delivery to investors by improving these frameworks, insolvency framework, on a country-by-country basis. And here, I think the role of the EU could be to bring clarity on what are the attributes of national insolvency regimes that would be more favorable to investment. And I think there is value in doing that. And I think there could be a shift from harmonization to things that are more about, you know, providing transparency, benchmarking, recommendations from the EU level in that area, because I think, frankly, harmonization is putting the political bar a bit too high, given the connections that are very deep between insolvency frameworks and national legal systems. On taxation, it's not the exact same story. I think it's more of a matter of, indeed, harmonization to have the possibility to invest on a cross-border basis with the same tax regime, and not and I think that could be achievable, but by unanimity. And I think here, actually, the idea that is at this point very much peddled by the French government of doing things like, you know, enhanced cooperation, coalition of the willing, I don't think that works for supervision, but I think it could work for some aspects of taxation in my more utopian days. Of course, there is also a very high political barrier to this, which is the consent of national parliaments. But I think you could imagine some pilot projects where a limited number of member states would create a single tax regime that would not probably be the most competitive in the European Union, but would at least give this sense of critical mass.
Okay, so there is clearly a lot of question on the role that this sovereignty power is going to play, and who are mostly against this, capital market union. Is more east versus west of Europe? I will add north versus south, or it is, some countries like Ireland and Luxembourg that so far are attracting a lot of the financial markets that are against. So is there any way to rank them, or all of them are playing a significant role, and this means that, we have, our hope to have a real capital market union is going to be quite low. So what is your view? What is the part that is more against the capital market union?
Should I take that one?
Yes.
Okay. I think it's interesting the way you framed it. North versus south, I don't really see it, except to the extent that, by and large, it's more, sorry, I'll be very politically incorrect. It's more northwest. it's more northwest versus southeast. So basically, northwestern Europe, including the Nordics, the Benelux, and Ireland, I would say, are where you have the highest level of financial development along a variety of indicators. And of course, pre-Brexit, that included the UK, but the UK is no longer there. And I think beyond that kind of, and that's historically understandable. I mean, basically, this is, the Hansa, the Dutch Republic, that's where Northern European capitalism developed first, and there is past dependency. So then the question becomes, what about Italy? Because they're the ones who really invented capitalism earlier on in the high Middle Ages, and I leave that question to the historians, but basically the marvels of capitalism, creativity that occurred in Italy in the 13th, 14th, 15th century are long gone, which is a fact. So now, East versus West, I think there's something to it in the relationship to sovereignty, and here it's not limited to finance. I think there are, to a certain extent, this legacy, this post-Soviet, post-communist legacy that many of those countries had to fight really hard to become sovereign countries out of the shadow of Moscow, and it creates, I think, difficulties to pull sovereignties that, many of the Western European member states, with the important exception of the UK, but it's no longer there, for various reasons, they have kind of abandoned their illusions of sovereignty to an extent. Maybe a good, maybe a bad thing. Sovereignty is never dead. Nationalism comes back, but I think you see what I mean. I mean, there is, for example, stock exchanges are a good example. I mean, many of those countries in the West abandoned the fetishism of the national stock exchange, including countries that are in other ways very nationalist, like my own country, France, early on in 2000 with the creation of Euronext, which is headquartered in the Netherlands, of course. And in Eastern Europe, you still have a lot of discussions that look very kind of, in a way, naively nationalistic, if I can put it that way, which is like, we need to keep the national stock exchange, otherwise it's the end of the nation. And so, not thinking of any country in particular, but I think we all have encountered this kind of reflexes. Now, I think on substance, the more important divide is the last you mentioned, is countries that have specialized and basically have, in a way, elevated their particularism in terms of capital markets activity to a core national interest. And there are not many of those countries, you mentioned two, but I think they play an important role in the conversation. And also, frankly, the UK is still there, even though it left. So I think the UK is providing a lot of support to that policy stance in the Council as a backbencher.
Okay, Tobias, do you want to add?
Let me just pick up exactly here. So one of the charming aspects of the regulatory competition solution is that you don't have to go to these specialized member states who have built infrastructure and partly depend on the income that is generated by these kinds of specializations on capital markets service provision, and tell them, we're going to take away your franchise, we're going to take away your game, because you can tell them, well, you will be exposed to competition, but you might have an edge in this competition, and you might turn out to become the winners who even eat a bigger pie than you've done before. So this is something that I think can politically help you. Second point I think is important. If you're talking to hardwired nationalists who think national sovereignty is something that has to be retained for its own merit, then of course you're doomed. But to all the others, I think you can say, look, nationalism is fine, and there are good reasons to, have some sovereign powers here. But on the other hand, this should not be something that just leads to shooting yourself in the head all the time. And if the retention of national sovereignty leads to welfare losses, then maybe it's time to think a little bit about what happens. And this is something that also, I think, speaks to this East-West divide, because a capital markets union allows savings from the West to flow more frictionless into investment opportunities in the East. And therefore, the scarcity of savings in these jurisdictions, in these economies, might not play such a big role, because if they have great investment opportunities, if they have great startup companies and SMEs otherwise, then you might actually generate welfare increases through relinquishing sovereign power. So this is, I think, something. And then just a footnote to something that has been said earlier by Nicolas. Unfortunately, I can't really keep silent on that. I'm not 100% sure if the banking union is really a proof of concept for the supranational integration of supervision, because if you look closer, the governance structure of the SSM, and particularly also of the supervisory branch of the ECB, clearly is still dominated by national players. So you have all these delegates in these bodies, and therefore, it's sort of a half-baked thing. But I think let's not discuss this because we're on capital markets union, not on banking union here.
Good. So, Nicola, okay, 1 minute because I need to go on. Okay, we have just for another 4 minutes.
Three super short points. On banking supervision, I'll have a paper published in a bit more than a month. So I hope this will convince Tobias, but it will be the matter of a future conversation. On the Eastern Europe, one thing actually that I didn't mention on Eastern Europe is that many of those countries actually, because of the difficult post-communist transition, have had to privatize the entire banking sector, which went almost entirely to Western banks. So the kind of benefits that Tobias is talking about actually has been observable and observed in the area of banking, because I think most economists agree that this banking integration, which was forced by post-communist bankruptcy, has been extremely beneficial to credit allocation in those countries by and large. Even so, I'm not saying everything was perfect, but the bottom line is very positive. Last point on Ireland and Luxembourg. I don't want to make it sound like those two countries are only kind of, protecting their turf, protecting regulatory arbitrage opportunities, reactionary, etc. I think they're making very valid arguments that should be listened to also on the risk of over-centralization and especially bureaucratism in an all-powerful ESMA. So I think the discussion about reforming and empowering ESMA should also take into account the risk of being too far away from market realities. And here the Irish and Luxembourgers have something to say, and that goes into the direction of what I was sketching, which is that the reformed ESMA should not be only in Paris.
Good. So let me just add one question, that is coming out from all this Q&A. That is, in a sense, trying to balance, the fact that you have one single, let's say, European supervisor, or, you have let's say, several in the different countries, and there will be a sort of competition that maybe will face some system to prevail. And, there is one point stressing that is, well, why not having 27 plus the 28 that should be the European one, that if the story of Tobias is working, it should be in principle the best, but because he's taking the best of all of the 27. And if competition will be not, a race to the bottom, we should have that this one will be the one prevailing. So clearly, maybe it will make even more mess, but I'm curious to know, clearly, since it's coming from one of the questions, what is your view? Tobias?
Just very quickly. So as that's guilty as charged, because very early on during the Capital Markets Union discussion, we have proposed the solution with the 28th regime. I was, however, probably the most reluctant in the team of authors back then, and I'm still am, because legal regimes create huge network effects. So this means that you will only choose a regime if you can be really certain what courts are doing, how supervisory practice looks like, etc. So therefore, creating a 28th regime, even though it might be on the books, the greatest thing on earth since sliced bread, may not necessarily be something that is appealing to you, because you don't know what during the legal process actually comes out of this. And therefore, I guess that if you don't somehow give a nudge to people in order to choose the 28th regime, it will have a hard time. Because Richard Portes has in the comments already told me that, totally flawed, everything wrong with regard to the regulatory competition idea. And one thing where I agree is that Delaware didn't come about as a winner in an incremental competition, but it was a huge nudge by antitrust regulation, but put him in the position. And I think you need exactly this kind of push. Or, and that's the big or, you start from a situation where some regimes already have built a reputation. And a 28th regime, by definition, cannot have such a reputation. And therefore, it is incrementally difficult for a 28th regime to just come in and be the prevalent solution that everybody favors. So there has to be more to this. And therefore, I'm always reluctant to recommend this 28th solution, although initially it looks very tempting.
Good. Nicolas?
No, I basically agree. So I'll skip this one just by saying that, it's an old idea. It has been attempted many times, and there is probably a reason why it has never really worked.
Okay, very good. So, there are other questions that maybe you can also go and reply directly to the single, let's say, demand. Clearly, there is one thing that remains on the table that is coming out, well, several, but, assuming that we need to have a single regulator, a supervisor, and the question is having this ISMA 2.0, it is better to have an evolution of this actual ISMA, or is better to have another, so start from scratch, like we did for IBA and the SSM, because the problem that I see is that ISMA is set up in a certain way and is full of a lot of lawyers, for example, with a limited competence, for example, on data analysis, on what the different institutions are doing, and so on. So maybe it would be better to start something new. So we will start from scratch, and we will have less problem than changing, even if from the political point of view, maybe it's easier to think to ISMA. So what is your, clearly this is provocative. I'm curious to know what Nicolas and Tobias think about.
Very briefly, I mean, in principle, you may be right. In practice, I don't think it works that way. First, I won't be said in the presence of Tobias that lawyers are incompetent when it comes to financial regulation. But more seriously, I think, there is path dependency, and you may wish ESMA not to exist, but it exists, it's there. And I think it has to be part of the path forward. I personally would be very favorable to a solution that would restart from scratch, because in a way it would be easier to build the kind of culture that I'm desiring here, which would be kind of more market-driven, closer to the market realities, at the same time with a clearer sense of investor and savers protection, I think. I mean, we haven't discussed Twin Peaks or that kind of concepts, etc. But I think very much of ESMA 2.0 as a conduct of business regulator, and I think starting from scratch may be easier to achieve the desired culture, but I don't think that's very realistic. And I also believe it's possible. ESMA is not doomed to fail. It's not hopeless. It's possible to work with the current ESMA, reform it, change it, improve it, so that we would have something close to what the European Union deserves and needs.
Tobias?
So just very briefly, I think that it's more about marketing, the whole thing, because the question, what you have to do if you really want to establish a powerful centralized supervisor, is probably very much akin either way. So if you choose ESMA as the authority to build, then of course you have to radically change it. You have to change the personnel, the staffing, its orientation, and because after all, it's not an operational supervisor. So it's just in very, very limited parts, and all you have to add comes probably very close to building it new. So the question is whether keeping the name is something that helps you in marketing this or not. So I think we all agree on this. But just a second. I think we agree that ESMA would have to look radically different than it does today. And therefore, I don't think there's a big difference. But the key message is, if you really want to do this centralized approach, then you have to really be willing to invest in both the structure of the supervisor its resources, and all the rest that is just lacking these days.
Sorry, I shouldn't have tried to interject directly. My apologies for that. But what I wanted to say is, I think it would be wrong to say all the staff at TESMA is bad. It's not the case at all. I mean, I say that because I know some of them, and I think there are real skills and also accumulated experience of the last, how many, 13 years or so.
I'm not saying that they're not good. My point is that, they can have done a lot of things better if they have a closer knowledge about how data are collected and how data are investigated. I can provide you a lot of examples, So why we are not having MiFID II a consolidated tape and we are having it in 2026 maybe, the question is why you're not doing it before, why we're not having a lot of other things, that is readable and easy to access rather than having all, satisfying all the requirements from the legal point of view, but impossible to use. That's the fact. And, so these are my points. So why are we having all this regulation? And this is the last point that I want also to ask to both of you, given that, for example, for MiFID II, it has been implemented with the consolidated tape for transparency already in 2006 in the US. We have only to copy it. Why we're not copying, just copying what the US is doing for transparency, and rather than inventing something that after 10 years we realize that is not working. Can you tell me why we are in this situation, Nicolas and Tobias?
So basically, I mean, I agree with the point you made, and I think we can easily find common ground here. There's a lot of valuable staff at ESMA. You need more staff and different staff if you want to do all those things that we're talking about. So agreement on that, but I wouldn't throw the proverbial baby with the proverbial bathwater. And the point about copying the US, I think it's natural that we Europeans want to do it our way. I mean, there are lots of politics in the background, right? There are lots of political interests. So I think it is in a way natural that even the best practices are not replicated spontaneously. But I think conversely, there's a lot to learn from US practice, and indeed also from UK practice or Swiss practice, or practice from other countries. So one advantage in a way of the EU of coming as a latecomer in these kind of financial supervisory integration project, and I think you saw that very much with European banking supervision. So I will keep defending the fact that that's really a success story, is the ability to learn not only from the best elements of what did exist in the member states, but also of what did exist abroad. And I think to a large extent, this has been achieved in prudential supervision. I would quote at this point the report of the task force that examines the SREP process, a single evaluation, the supervisory review and evaluation process last year. And I think there could be a lot of that also in the area of capital markets going forward.
Good. So Tobias, the last word.
Yeah, no, not necessarily the last word, but just given that we're short of time, just two observations. So first, I think that European financial regulation and also banking regulation has always had some difficulties with transparency. You can say that throughout the board, essentially. So, and just with regard to market transactions transparency, part of the story might be that, of course, some incumbents do not like transparency of prices too much, because then, of course, competition is enhanced. And therefore, you're coming back to these political economy stories that we've been telling throughout. And I agree that, of course, there is now a chance, if you really mean it, to learn from experience, examine it very, very thoroughly, of course. But then I think the way forward is there. There's a layout how to do it, and we should do it.
Okay, so let me thank we are already very late. So thank you very much, Nicolas and Tobias. I think it was a very interesting, debate. I learned a lot. So thank you very much, and I'm looking forward, to further discussion about this important topic. Have a nice day. Bye-bye.